Thanks, Elena, for joining us. So maybe just do a quick intro of Elena and then let her introduce herself. So you are leading growth at Lovable, which includes monetization, very important. I think that's like the right home for monetization, to be honest. And really excited to have you here. Lovable is obviously one of the most famous companies right now in the Valley, or not even in the Valley, in the world, and is doing really cool stuff with pricing and packaging. And so we are so excited to have you here. Maybe you could just do a quick introduction of you and kind of what you do at Lovable.
Yes, hi everyone. I'm so excited to be here and dive into pricing and packaging. It is a lot of time I'm spending thinking about it, so I would love to see all of the questions that you all have and just have this discussion with Scott. Spoiler alert, it's not like everything is figured out. I think we're like very much in the messy middle of still figuring out what is pricing and packaging with AI products is going to be like, but I have a couple lessons definitely to already share with you all. But I'm head of growth at Lovable. What that means is that I'm really responsible for self-serve revenue and helping layer in on top of it enterprise sales motion as well. But I'm responsible for the normal activation, monetization, retention journeys, as well as PLG acquisition and collaboration with marketing and product. Before that, I was advisor at many companies. My superpower is pattern matching across the space. And then I held operator roles, companies like SurveyMonkey, Amplitude, Miro, Netlify, and Dropbox right before Lovable. But excited to be here. Let's dive in and let's get into those hairy pricing and packaging topics.
Awesome. Well, super excited. Just to ground folks, I'll just tell them like 2 sentences about what Metronome is, and then we'll jump right into Lovable. So just for those of you who don't know, Metronome, we are designing ourselves to be essentially monetization infrastructure for businesses that are super fast growing, tend to be AI or infra SaaS businesses. The kind of core value we provide is we do billing, of course, but we also build essentially APIs and product experiences so that customers can kind of get the most out of your product. The way we like to think about our kind of unique belief is that people think billing is this thing. It's like you need to issue invoices once a month. But the reality is building a true growth engine on top of a billing system is really freaking hard. There's a lot of concerns in finance and customer experience, managing workflows or data flows from CRM, ERP to ERP systems. And we kind of work to go make all of that butter smooth so that you can spend more time like actually building and growing your product itself. So with that, maybe Elena, I would love for you to just walk through Lovable's current pricing and maybe the recent pricing iterations and how you're thinking about what might need to change in the age of AI, or as your company grows. Like I think you just crossed, what was that? Like 200 million ARR in a year? Like,
yeah, we're just
bad.
a year. Yeah, we're a year and 2 weeks old post-launch. So that's a very important milestone. The product was actually being built for a year before that, but when we went public was November 21st last year. We just crossed 200 million in revenue, which is pretty wild. This is also only 4 months after we crossed 100 million. So it took us 8 months to get to 100 million and only 4 months to double to 200 million. So there's definitely something compounding here, and we'll chat about how our pricing and packaging enables it and potentially decelerates it at the same time. So it's not like we have figured it out. So please don't look at our pricing page saying that, oh, this is exactly what I need to copy. There's a lot of nuances in it, and we'll talk about that. But just because we're going to be heavily referencing Lovable pricing and packaging, I want to give you a really quick overview of the main components of our pricing and packaging, so we're all starting on the same page. So we have 4 plans from Freemium to Pro, Business, and Enterprise, very standard B2B lineup. Freemium plan is heavily anchored on just initial aha, not from activation perspective, but aha from capabilities perspective. So that initial prompt, we actually give you 5 credits completely for free. And then on the first day, 30 total in a month. So you can come back every single day and renew those credits and continue building completely for free. And that initial preview is what drives most of the conversions to say, okay, now I to do more. So from that perspective, freemium is a really important part of our strategy. It costs us an arm and a leg, but we view it as a marketing expense, not as a cost center. So in fact, we're constantly talking about how we can give away more product for free, not how we can tighten up our margins or how we can improve our free to paid conversion rate. But some of the important aspects here is Freemium is definitely a really big portion of everything that we do, even though it costs a lot more than a traditional tech SaaS company, I would say. The second of all is our main metric is credits. This is the one that I have quite a bit of beef with, and we can chat about this, but we sell credits that are then translated into building actions for the customer. And we have our own formula of how we do it. We can dive into it as well if you're all interested, but there's different tiers of credits that you can have. There's very important nuance around credits too, is number one, we do offer credit rollovers. This has been, when we didn't have it for the first 5 months, everybody was screaming at us saying, okay, hey, I'm not building consistently every single month. If you just expire my credits every single month, it makes me just want to churn from you. So we introduced credit rollovers, which actually did not impact our conversion or pay-to-paid upgrades. In fact, it only just improved retention, even though we gave customers more, so to speak, of their credits to keep. So like no negative impact, even though there was also like internally a little bit of angst of like, oh, are we going to negatively impact our pay-to-paid upgrades as a result? And then the other one that is also super important to note, I don't have a highlight here, but there's that second check mark underneath Pro Plan that says 5 daily credits up to 150 a month. This is one of the, I would say, ingenious growth hacks by our co-founders, where on top of your purchase credits, you actually just get free 5 daily credits to continue building. So even if you run out of your credits on a monthly basis, you can come back and still do the tweaks, and that drives some of the habitual loop. And that's something that is working for us very well, and something that I would not tread back on, and honestly would probably implement in every single product that I would ever work going forward. And then the important thing here to say that we've changed over the last 5 months is that we used to actually have a price per user, but then we deemed that the user for us is an input metric, and we want to unlock as many input metrics as possible and monetize on output metric. And our output metric is credit consumed, and input is users that will be consuming those credits. So we actually remove the per user pricing and per user allocation out of our self-serve model. So it's now shared across unlimited users, and you buy just credits on the workspace. So this is our attempt to move towards outcome-based pricing as opposed to charging for inputs and stifle growth. And that, by the way, has increased collaboration in our workspaces 10x compared to before, even though we're not yet even fully collaborative product, but more people actually invited more users. But it does create some friction in enterprises that want to charge per user. So that doesn't come without some negative side effects as well. And then enterprise plan is something that we've introduced really in the last 4 months. We felt pretty strong pull from the market of people saying, hey, I want to buy this for my entire company, but I need SSO, I need MSA, I need some security review, and I need some customization on the workspace level with granular roles and permissioning. So we launched an enterprise plan, but at the same time, we launched business plan that almost mimics all of the enterprise level features minus some of the services that we offer. So for example, you can see SSO is our self-serve feature, not enterprise feature. And that is because we had sales team really focus more on the upmarket, and companies that are more in the SMB or mid-market territory, let's say under 1,000 employees, can still continue transacting with us self-serve by continuously getting all of the same functionality like data opt-out and SSO, which is really neat in order to be able to work with us. So we have like this feature set that is quite similar. It's just the enterprise is a much more volume pricing flexibility and contracting features, so to speak, that we have to offer. And then that's all I wanted to say on our
Cool.
pricing and packaging. I will just say the last thing, that the majority of reasons upgrade because they need more credits. So features is a way to kind of almost discriminate between like what is it that you want and how much sometimes it costs us also to produce some of these services. But credits maintains to be number one upgrade trigger for us.
Oh, yeah, actually, I was going to ask about that. So, I mean, maybe we could just linger on this page for a while because I probably could ask like 5 hours worth of questions. So, talk to me a little bit about how you're using basically which Are there substantive product features that like a prosumer user would need that are gated by packages, or is it purely just like the amount of credits that is kind of like the key? Like I see a bunch of different sub check boxes, but I'm like curious if it's like
Yeah.
if there are product features that are like gated behind a paywall, or if it's mostly like it's like the features just consume more credits and therefore you need to upgrade.
Yeah, I would say that the biggest features is ability to publish on your custom domain. So that is a paid functionality for us. It is to remove Lovable badge. So every single app that is published by default gets a little edit with Lovable badge on it, which is, by the way, our casual contact growth loop. So
For sure.
more people see it, like all of the traffic on Lovable app becomes marketing real estate for us. We obviously in the free plan, that's how we are able to give away a lot of our free plan because they help drive us product-led growth loops. You know that free is never free at the end of the day, but we try to make it so it's people don't mind that badge because they're proud that they've built it on Lovable. But for more serious applications, you can remove it in Pro and limit our virality. But there's an exchange, obviously, in monetary that comes along with it. And then roles and permissions becomes a big one because even though we have unlimited collaborators in every single plan, if you want to actually set people's permissions on view only or specific projects that they're able to edit, then you'd have to upgrade, which makes a big difference once you start actually working with the team in Lovable. So not everybody has terminal actions in order to do it. And then for business plan, the two biggest differentiations is SSO, because some companies just cannot engage with software unless they are on SSO. Their security team is going to block it. And the data opt-out, which is a really big one in the AI world, and something that you should definitely offer to your business customers.
Very cool. Okay, would love to understand the credit model a little bit more. So, I see you get like 100 credits per month, and then you have this daily 5 limit, which do want to talk about because it's like very smart. What happens? Like, do you have the ability to like top up or kind of like buy additional credits, or is it like is that like an excuse to move to a different package?
Yeah, so right now there's that 100 credits a month is a drop down. So you can select 200 credits a month or 500 credits a month that you can buy. Most of the people start with 100 and we default to 100. So it's not that we default to more either because we're not looking to fight utilization issues. We really want to drive expansion. So we're not trying to upsell people upfront. Our overall goal is number of paid users, not average revenue per user. So we're not revenue optimizing yet, which is kind of funny. Like we're growing revenue so quickly, yet we're working zero on revenue optimization. It's all about just landing as many paid customers as we possibly can. But that's tied to the life cycle of the business that we're in. We're not in the growth scaling stages. We're still, even though we're 200 million, we're honestly like in product market fit kind of stage still too, because our product is evolving so quickly. But you can buy multiple different packs. We do have incredible pay-to-paid upgrade rate, especially in the month 1 and month 2. After sign up, that's when the most building happens. So people upgrade the tiers. We do have overwhelming feedback that the top-ups are needed as well. So not just subscription-based tiers, but to offer a la carte version of buying some credits. And that is something that we're currently A/B testing in the market to find the right price point for us that enables the most engagement, but at the same time gives us a nice monetary composition of what our business is going to look like. And it's very fair to users that they accept it as being something that they're willing to engage in. So top-ups is something that if you don't have it on top of your credit subscription model, just expect your users to yell at you night and day about it. So even though there is a potential of risk annual recurring revenue, because top-ups is a one-off purchase, it's not a subscription purchase, the indication is that the retention improvement from people that are buying top-ups is going to be outweighed by any loss to paid upgrades that you would have in the meantime. So that is our bet, and we're hoping to launch it in January. We're actively testing it right now.
I'm curious if you've noticed any interesting behavior with respect to top-ups, and maybe it's too early to like know, but like, do you expect that it's like the user story is like, oh, I just need a top up this month and the next month I don't? Or do you suspect it's like, actually, it's almost like you're pre-buy, you're kind of testing out, do I actually need 200 a month? I'm at 100, maybe I need 200. And it's like, do you expect it to kind of be this gradual like stair step where that like one-time purchase becomes a recurring purchase in out months, or do you have an expectation yet?
Yeah, so we are seeing a pretty big engagement lift by offering top-ups, regardless of the price point that we do it at. So from that perspective, it's going to be a go on this feature anyways, even if there's some loss to revenue. By the way, the one thing I will say, which is very different at Lovable compared to any other company that I work with, we're constantly talking to ourselves as to how can we make product cheaper and how we can give more to users. So we're actually have a lot of initiatives that are anti-revenue that end up in more revenue because you do what's right for users and they repay back in space for you as opposed to optimizing for revenue. So yeah, we track revenue, but everything that we talk about is how we can make it more accessible to people, not how we can monetize people a lot better. That like is a very important distinction that is really hard to have in a larger company when you're like truly revenue optimizing, but it's just a blessing when you can have it in a more of a smaller business, especially that is not bound to have some misses, let's say, in the forecast that you need to constantly make up and optimize heavily for revenue. But we are seeing engagement lift from top-ups for sure. It is too soon for us to tell. So I'll post once we have more learnings on the top-ups, but so far it's looking to be a pretty positive exercise on the user engagement, which honestly, even if there's a hit on revenue, we probably will roll it through because we're just going to bank on the improvement in retention. An important thing here, sorry, just one last thing, is that as we're also looking at the building behavior, so like how people interact with Lovable, so many of them do it in streaks, like we call it streak building, where like you come in and like for 3 days you build really, really heavy, and then you quiet for a couple of weeks. And just like doing upgrades in the higher subscription and then downgrades when you don't need it anymore, it's a lot of paperwork, so to speak, that we push on our users that is completely unnecessary. And we're even thinking about the model that we don't have additional subscription tiers. It's just each top up, you can either subscribe to a top up or buy it one time. So that way it's like kind of simplifies the entry point. And if you subscribe, it's a little bit cheaper of a price per credit. If you buy it one time, it's a little bit more expensive because our margin profile is not that cushy 80-90% the way that traditional tech SaaS is. So we need to be a little bit more mindful about the recurrence of it.
Okay, very cool. Well, let's talk a little bit about credits because when I think about credits, it's like it's a useful abstraction for a business, but it is kind of abstract to a customer. And I think you've said the word customer probably 17 times in the past 2 minutes. So like it's very clear you're very customer centric. How are you all thinking about the kind of is credits the right thing versus like maybe a dollar spend or a euro spend or whatever currency spend? Like how are you thinking about that?
Yeah, I think overall credits is a pretty shitty metric for a customer. The reason for it is because everybody just invents their own definition of credits, and nobody can compare businesses anymore in terms of how much they cost. So it's really, again, not fair for a customer because they feel locked in and there's completely obfuscated in terms of how they're actually going to perceive it. And also, there's so much mental model of how much I believe this action should cost versus how much it actually costs me in credits. And there's unpredictability in this. It's like, oh my gosh, I spent this many credits. Where did they go? I didn't want to spend this many credits on this action. So there's still like calibration even between what we expect AI to do and how much it costs AI to do it, because some of the actions are very cheap for us in our brains versus they're still very expensive from AI computing power. But we very specifically do not do, let's say, LLM tokens. So like, it's not like we're saying, oh, you get $1 million LLM tokens. That doesn't really make much sense anyways. And like because then each action is like 1,000 tokens. Like, I don't know, it just feels it's like inflation and currency type of thing. So we do credits, which just has a baked margin on top of LLM tokens that we protect ourselves with. So that's why it's passed through. But unpredictability of it is something that I'm very unhappy with. The fact that people cannot compare it across our competitors, I'm also very unhappy with. I want people to choose us because we believe we're fair price, not because we obfuscated our metric to the oblivion. So right now we're exploring other ways that we can potentially create a wallet for people to use at Lovable that they can use across different usage metrics, because we don't also have building, we also have hosting portion of it, and then there's AI gateway, and then we want to even introduce additional AI agents on top of your experience. Like I dream when we have an Elena growth agent for every Lovable app that can like go A/B test experiences and like work on your activation metrics. But for that credits, like I don't know if I want to continue creating different formulas for different usage metrics and stuff it into credits, versus would we go back to dollars, or will LLM costs get cheaper that we don't need to have it so tightly coupled with usage, and then we can go back to like more per user or per app type of pricing. So I mean, I don't know how far we're away from it, so for now, like we can't plan for that entirely, but that's kind of in the back of my mind. That's credit is like intermediate pricing unit for us in the meantime. I don't know if it's going to be long term.
Well, so something that's interesting, because you and I both worked at Dropbox, and you know, we like in these SaaS era businesses, you kind of could assume that you'd have a certain margin. Like, and yes, you'd sometimes launch a feature that like meaningfully changed it, kind of. But reality was that like you got fat margin kind of as out of the box, and that's kind of one of the beauties of like 10 to 15 years of software. AI software is not that way, at least not right now. And so maybe talk a little bit about how you like, you know, you said margin probably more times than in my 6 years at Dropbox I ever heard that word come up. And so I would love for you to talk about how you're like, as a growth person, as someone who deeply understands the user and has to like manage price, like how does margin factor into your like pricing and packaging design? And then I would love to just talk about margin just broadly across a set of packages and how you think about that as a business like owner.
Yeah, so in traditional tech businesses, it's not uncommon to see, let's say, 80% margin profile, versus in you talking about AI businesses, you're closely more talking about 40, 30, 20% margin profile, depending on how much pass-through buffer that the company puts in on top of the LLM costs that they're using. Because let's face it, we pull in AI from OpenAI, from cloud, from like all of these other sources. And then we add a buffer on top of it. We have to, because we need to cover our cost of doing business. Now, our margins are definitely not an 80%. I can't disclose, unfortunately, exactly what our margins are. We're a private company, but they're in that 40, 20% range compared to all of the other AI companies. But what we do differently is, though, even though with those 80% margin profiles, there are so many companies that were completely unprofitable, which is kind of crazy to think about, because when you have like such a cushion that you're sitting on, the interesting thing that I see in AI is that a lot more companies are profitable because they are very tightly thinking about that margin. So we talk about that margin all the time. In fact, we often say, hey, we need to reduce our margin to give more product away. So like, let's eat the costs more. But we're nowhere close to like needing really long runway to like make profitability the way like Uber went public with like billions of dollars of ARR and still no profitability inside. So from that perspective, I think that really high cost actually introduces a lot more rigor about understanding the dynamics of your business and how you're going to spend the money too. So for example, we don't spend a lot of marketing, not a lot of money in marketing and sales. So much of our growth is product-led growth, and we put that pressure on and over again on product to drive it. We have very tiny team. As I said, we're 200 million in revenue. We're still only 100 people. So like the revenue per employee is really high. So we're continuously driving that agency and autonomy to make sure that we're not creating bloat in our system, and we are behaving as AI native as possible to create as little of dependency and cross-functional debt, so to speak, as possible. Obviously, it will come. There's no question it will come, but we're hanging on to it for dear life. So from that perspective, I think it's just like where we spend money is quite different, because our cost on headcount is pretty low because of how many people we have. Our marketing and sales budgets is very low, so most of it is just coming from R&D. And because it's all product-led growth for the most part, that R&D just really fuels all of the growth levers.
Very cool. Very cool. And maybe talk a little bit about when, you know, because you're running pricing and packaging, and you have, at least on this page, 4 different SKUs. When you think about, you know, setting price levels and margin, like, are you like, how are you balancing the SKU view? Like, I think earlier in the thing you said, like, basically the free tier is a marketing expense, which is like a very interesting way of thinking about it. And and uh and so, like, when you're balancing margin, are you kind of balancing like different SKUs against each other, or is it more like you're looking at the blend and you're just saying, look, here's our total, like, we're setting out like overall margin target of X or Y or Z? You're also not in the like optimization phase, so I assume that question will change dramatically as you start to optimize. But generally in this phase of like hyper growth, like, how are you essentially using the different SKUs to balance margin?
Right. So majority of people buy pro SKU. So business SKU is maybe like high single digits of our revenue and number of customers that are purchasing it, because it's a more specialized SKU for some specific features. And like SSO costs money. It's like a very hard cost to provide SSO. That's why we have to charge more for it. But even then, we launched it at business plan, for example, at $50 compared to $25 for the same amount of credits, which, by the way, how those decisions made earlier is just like, okay, the wind is blowing this way, let's go and let's test it out. We decided actually that it's too high, and right now we're in the process of lowering that price. So it's going to go down to $40 a month, because we're like, we overshot it, so we need to go down and make it smaller. So the team is working on that. In terms of the overall profitability, though, we're looking at it as a whole. We're not optimizing it per SKU. Pro, because that's where majority of our users are, is where we're looking at our margins the most. Everything is on top of that, like it's higher price, so it doesn't really matter. The only other thing that I would just say is that on top of what you see in this pricing and packaging, we give so many credits away for free. So like, if anybody wants to host a hackathon on Lovable, we give 100 to 200 credits to every single participant, completely for free, without any strings attached. Because again, like, we really view that freemium and free credits giveaway as our marketing expense, and we give it to anybody and everybody who's willing to either try it or to give it a shot. And it is really big majority of our overall cost. So like, when we're talking about margins, we're actually talking a lot more about making sure that our freemium is not a runaway train, but at the same time being very aggressive in both vertical plays like EDU, for education, for nonprofit, for startups, for specific geos where we're just like too expensive with our USD pricing, to giveaways on events to our users, to basically be marketing agents on top of Lovable just by giving them credits. And it's a win-win situation for both of us, and on top of our freemium as well.
Very cool. Awesome. And you mentioned just now that, like, there's like price changes coming up in the future. And if I'm doing the math right, 200 million ARR divided by $50 a month, that's a lot of people who are using this product and it's growing super fast. How do you think about I always thought of it as like the grandfathering problem, but basically like executing pricing changes against a relatively large customer base, and like kind of like how are you all thinking about that problem, and is it different than it was at Dropbox or any of the other companies that you've worked at?
Can you ask the question again?
Oh yeah, sorry. What I'm trying to understand is, like, basically one of the classic annoying problems of changing pricing and packaging is you have a bunch of entrenched users who are like on a certain package at a certain price. And so, like, how are you thinking about, like, essentially pricing migrations, or like, whether or not to like keep, a customer on the old price or the new price? Like, how are you thinking about that?
Yeah, I would say anywhere outside of Lovable, I would be very stressed about how it impacts existing users, because anytime you introduce any pricing changes, what you do, usually the playbook is you test it for new users, because that is the future. So you try to understand, what is my path in the future going to look like, and is this a positive or is this a negative? Anytime you do any pricing changes on existing users, it's always a negative most of the time. Even if you honestly lower a price on them, they're still like, I don't like pricing changes, because we as humans want to have stability when it comes to our monies. We work really hard for our money, so we don't like when company changes. We don't want to like have airplane buying, airline ticket buying experience, where like which hour you visit, the different price shows up. So we do still do all of the testing on new users. That is very important to us. We're pretty open about it in our community, in our Discord channel. For example, we say, hey, you might see different prices. We're collecting a data on this initiative. So we try to be as upfront as possible. We know that there's going to be cross-pollination between control and test experiences. That just comes with the territory. We're just looking at overall trends and then impact to engagement to at least get a directional value. We're never going to assume that those are going to be exact lifts, but we want to understand the overall movement of the business. Again, most of the pricing, by the way, for changes for us are meant to drive more engagement, not necessarily more revenue. So they're anchored a lot more against activation, retention experiences, not so much just get us more revenue from the user, because we really believe if we get more engagement, there will be more monetization in the future because we already have good monetization going. And then the second piece is what to do with existing users. On existing users at Lovable, we just take a hit. We just lower the price, we just make the changes, we try to make them whole. We've never done we've done one price increase before I started, so it was very, very early on in Lovable journey. Since then, we haven't done price increases, we only reduced the prices, which has been positive for users. But we also, because we're constantly changing the pricing and introducing new things, like we introduced roll-up, we introduced EDU discount, rollovers, we introduced the EDU discount, we introduced this new business plan, the new enterprise plan. Our customers kind of start expecting that it's an evolving thing, so they don't react as negatively when you change it, because it kind of becomes the norm of the experience. Versus if you wait, let's say 1 year, 2 years, 3 years before touching your pricing and packaging, which is very lucrative from sometimes internally, because like, oh, we're keeping it stable, but you're actually teaching your customers. Yeah, but you're leaving a lot on the table because market is evolving so quickly. But most importantly, you're training your customers that your pricing is stable, and you don't want to train them that it never changes. So from that perspective, we do take a hit. I'll give you like one example. When I joined, we had a team plan that was pricing per user. I had a very high conviction that collaboration should be free and unlimited. So we pushed to unlock it and make unlimited users on every single plan. And as part of Teams plan that was at $40 a month, by the way, we've migrated them all to Pro to $25 a month because there was no change anymore, because that was the only differentiating feature in the team plan. And we took almost $4 million hit on our revenue as part of the migration. So there was like a little blip, and then just accelerated like crazy as well, because again, we ungated the input. So very scary change. And especially in more traditional conservative organizations, that would have been maybe even not unacceptable. I'm very grateful that at Lovable, we still can invest in the future. We're not bound we're a private company too. So like we have a little bit more leeway to make some of these changes. But at the end of the day, if you invest into making user whole, it ends up being long-term much more beneficial to you than optimizing for short-term revenue. So short story, we take a hit, and we just say we're going to do right by users, and that's going to pay off in the future.
Very cool. Okay, actually, one thing you said that is like I'm realizing is, because you're only a year old, but the level of sophistication and kind of like you're thinking about this at like 10 levels of thought. Obviously, you're an expert at this, but how do you think that AI companies broadly, like, you said something that which I strongly agree with. It's just like, if you don't change prices, you train users to like fixed price, and you train them that like the product value is not evolving that much. And in the age of AI, product value is constantly changing. So like you should expect like in some level that like price, at least to the amount you're spending, will change. How would you recommend, let's say like there's people on this call who maybe don't have this level of product market fit that Lovable has. It's very hard to like achieve that. But let's say that you're growing, you're doubling, you're tripling or whatever, you're doing well. But you're not playing with monetization, pricing, and packaging. Like your pricing page is not nearly as sophisticated as this one. Like, how do you like toe dip on this? Like, or how do you start to get like that like sophistication to start to weave this into your product development process?
So first of all, product market fit at Lovable, I think, is some of an illusion too. So sorry, quick 30-second rant on that, because yes, we make many millions of dollars in revenue. I still think that we're in a product market fit, what I call treadmill, where in the next 3 months we can lose it, because we have lots of competitors. Technology is changing super fast of what LLMs are capable of doing, and customer experience and expectation changes really fast, like in a matter of months. Something that used to take years for customers to change their expectations of products are now like taking a couple of weeks. So from that perspective, we're very much trying to stay on product market fit treadmill. We're not in the blitz growth stage of what I would say, even though normally speaking, when a company is a couple hundred million in AR, they're most definitely in the blitz growth stage. But in any company in the AI category does not have a product market fit yet, no matter how much revenue that they're making. So everything is still up for grabs very much. It's all about who's creating the most moats to give themselves more room to maintain that product market fit as they're catching up to technology or customer expectations. That's really what it's all about. But in terms of pricing and packaging, so until I would say that in the first $1 million, maybe even first $2 million in ARR, like don't mess with your pricing and packaging too much. Really put in your best hypothesis out there that is grounded in customer expectations. So don't try to reinvent it too much unless you have like a really genius stroke of idea on how to do it differently and you have a really high belief in it. But a lot of it's just intuition based. My only point is that you have to start using and experimenting on pricing and packaging because of this really quick change in market customer perception, high competition because of software development costs are going down, and LLM change really early on. So Scott, this is something that you and I have talked about, that usually it takes companies about 5 years before they start doing a lot of pricing and packaging work. Almost all of the AI startups are forced to start doing it in their first year. So the pricing and packaging stream just starts a lot earlier. Although I would recommend for you not to run it out of finance at the beginning. I would recommend not to run it out of marketing at the beginning. Product should really own pricing and packaging here because it has to do with LLM that they're consuming. It has to do with usage and utilization that is happening in the user, and just take more of an experimental approach. Hear what customers are saying and just try things out.
Yeah, I mean, like, just look at this page. Like, I think you pointed out like 5 or 6 things where I would say like the 5 credits per day. Like to me, you could getting to that insight requires deeply understanding what the customer's doing and what you want them to be doing day in, day out in the product. And you're only going to have that insight if you're like in the product, And so that's why I would say definitely when you're early, like it has to start in the product order. I would argue that it should always be in product inflected and deeply understood. But yes, I definitely
let's be real of what it actually is in the companies, and a lot of times it ends up in the decks that are not getting implemented.
Well, exactly. If you want it to be effective, that's maybe the best way to put it.
That's right.
Okay, awesome. We have like hundreds of questions, so I'm going to turn it over to them. I'm going to start like asking questions from the audience just because there's so many, and Maggie will take it away.
Cool. Yeah, we have a ton of questions, and if anyone hasn't asked questions yet, feel free to continue to add them in. The first one, I think you talked a little about who owns pricing lane and when is the right fit. Can you talk about how Lovable's product and engineering org structure supports you driving monetization strategy out of the growth function rather than other setups like inside of product?
Yeah, so first of all, growth function for us sits with product. So it's very intertwined. Even though there is one single decision maker, which is me, that is driving some of those changes and reconciling, we have a lot more people involved in it. So for example, when we released our backend offering, which we call Cloud, because before you had to integrate with Supabase separately, now we just offer it as a seamless experience. It came out of that team that was creating that feature. They created the proposal, they created the pricing and packaging for it. I just folded it in, but it was very much a pull, like a downwards bottoms up decision that was made. However, we do have a formed now monetization council that has marketing, sales, product leads, and engineering leads in it. So any big model changes that we have do go through that monetization council as we're growing a little bit bigger, so everybody's on the same page in terms of what's happening and why it's happening, because pricing decisions just impact everybody across the board, versus some of the optimizations and moving things back and forth that are completely up to the bottoms up team to go and own it. But it's helpful to have one single owner. In this case, it's me, like it's on my shoulders, but I have a lot of help. I'm not fooling myself that this is just me, myself, and I. This is a team effort, and I pull in people that are all very passionate and have a lot of experience. I just try to basically herd the cats to run in the same direction.
Great. Follow-up question on like market testing and experimentation. So I know you touched on this a little bit, but I think folks are really curious, like how do you run experiments across like which cohorts, and like what metrics do you look at before you scale an experiment to the user base?
Yeah, so we always start with new users just to test the completely, because existing users already have a set perception of what your pricing is. New users, it's helpful to really get unbiased opinion as much as possible of what is actually going to happen with them if they engage with new pricing. We don't do right now anything like painted door tests where you just like fake it until you make it. We actually create full experiences. We run on Stripe. It's fairly straightforward. There has been a lot of issues for us to create different pricing experiences. And we just do full-blown A/B tests, whether they're global or whether they're regional. So for example, we'll be testing a $5 entry point in India, Brazil, and Indonesia in January, because $25 entry point is just like unreasonable for those markets, given GDP differences and purchasing power. So we're going to do a full-blown A/B test and then run the cohorts through. The most important thing on the pricing experimentation that I will say, though, is that we figure out the sample size on how big of a standard error we're willing to accept. So basically, what kind of lift are we looking for, and how many customers do we need in order to measure that lift? And then we collect that many observations, and then we stop new assignments. This is very important. And then we continue watching cohorts to see how some of the retention and expansion and further down engagement material actually like materializes it to be. Meaning that just the testing window is just an assignment collection window. We actually watch it for 1, 2, 3, 4, 5 weeks later before we make the final call, because most of the pricing and packaging decisions is not just the purchase, it's very much the impact on the entire growth model that you want to have an assessment on. And then just the last thing that I'll say is that we, sorry, what was I going to say? On metrics. So obviously major metrics that we always look at is the free to paid conversion, the first term retention, or like nth term retention if we're going after some existing users, and paid to paid upgrades. So expansion and net dollar retention is something that we're obsessed over quite a bit. We don't want to create a leaky business with very low retention, and just like we have to constantly put in the pressure in acquisition to make up for churn. We want to have a really strong net dollar retention and pay to paid upgrades in order to keep the revenue from the cohort as stable as possible, and hopefully create that smile curve at the end as well. So those three metrics are kind of, so free to paid conversion, retention, and expansion are all the time on metrics. And then the last one is engagement with the product is something that is a must have. And then there's the sub KPIs that are specific to the test cell that we create that are custom to each experiment.
One quick question, actually, because your growth has been pretty astronomical over the past year. How are you all thinking about long-term retention? Like I can understand, like, you know, period to period, but like you probably don't have it. You have like a very small number of customers who've been with you for a year. So like generally, how are you thinking about that in this business? Especially I see you have annual plans on the page. Like generally, how are you making decisions across annual plans given the like relative youth of the business?
Yeah, so annual plans is something that we actually only launched about 4 months ago. You can see that it's actually disabled. So we don't push people to annual. We want them just to try monthly and get as many paid subscribers through the door. Anytime you default to monthly, you usually increase your conversion rate by about 15%. Every time you default to annual, you decrease your conversion by about 15%, but you improve your retention quite a bit. But with annual, we would have to work a lot more on utilization. And right now we're not ready to really work on utilization utilization of annual plans just yet. So we don't want, unless people really want to commit annually, we're not pushing them to commit annually. And that's very important for us in our life cycle stage, although that will shift as we get more mature. And then in terms of the long term, as I said, we obsess about retention and expansion. Free to paid conversion is nice. And obviously we want to get as many paid users through the door, but our ultimate North Star is all about app success. So what people are building, and is it successful? And then do we see a strong retention out of it? So I know that there is a lot of noise in the market right now saying, hey, AI companies are all about hype and there's no retention, it's a leaky bucket. Although I cannot share with you our exact retention numbers, what I can say is that they're just as good, if not better, than what ChatGPT shared about their retention numbers publicly. And across all of the companies and prosumer businesses, self-serve businesses that I worked at, our retention numbers is right on par with them. So from that perspective, I see that there is a strong product market fit pool, maybe not like full fit just yet, as we're still on the treadmill, but it's important just for everybody to know that we're not trying to optimize for hype. We're really trying to optimize for value and overall retention. That is something that we literally obsess about, and how we decide on our ICP of our ideal customer profile, the markets that we're going to be in, and who is it that we're building for.
I think a follow-up on the monthly versus annual. I think a lot of folks had questions also on like credit rollovers and how Lovable thinks about that, either on like a monthly or an annual basis, and then how kind of like your free plans then convert into like self-serve plans convert to enterprise and pricing there.
Yeah, so I'll start with the self-serve to enterprise. Self-serve to enterprise is an ongoing story that is being written. We have tried different ways to monetize our enterprise. We're still very much experimenting on it. So originally we were doing it per user because enterprises were still pushing us to say, hey, I have this many employees that I need to give access to. What's the price per employee, so to speak, that I'm going to pay? That was actually quite hard because it stifled our adoption across the company, because that only this many employees can have access to it. So we're moving to some different models where there's just a platform fee and it's a pay-as-you-go credit usage. So we're trying to unlock it to be more enterprise-wide, but there's not, without the push from enterprises and wanting predictability and price per user of something that they want for their comfort level. So we're a little bit at odds with it. So I would say that we're still testing a lot of our enterprise pricing because it's not as straightforward as just like expanding on top of self-serve, because there's a lot more considerations for budget predictability and just stability in the contracts that enterprises want. So ask me maybe in 3 months. I will have a lot more information for you on how our enterprise pricing is going. But we also, the one important thing to say is that all of our enterprises right now are closed on top of self-serve. So there's already usage, there's already validation, and enterprise in an expansion motion. It's not a new business grab. And that is very important to say. So it's like it's built on top of self-serve. It's not built as a separate stream next to self-serve. Will we be doing pure sales led in the future? Maybe, but honestly, with the amount of customers that we're getting through our self-serve, it will be very hard to find an enterprise that doesn't have at least one Lovable user in the future there. So it's going to be always a connected motion. And then on the rollovers, rollovers right now are fairly limited in the sense that you only roll over for 1 month forward, and then the rollover balance expires unless you have more credits to continue rollover. So you basically, if you have 100 credits a month, you max that you can have in any given month to spend is 200 credits, meaning if you rolled over a previous month's 100 into your this month's balance, and then you renewed with another 100. I'm considering whether we should expand that out for longer term rollovers to prevent churn, because we actually use it as a retention tactic, that you lose your rollover balance if you churn, and you keep your rollover balance if you stay a paid subscriber with us. So we want to give our paid users more reasons to stay and accumulate as many credits as they possibly can.
Speaking of credits, there are a lot of questions on the customer experience side, which you've touched a lot on, of how can users understand the credit implications of decisions as they build, and what does that look like at Lovable today?
Yeah, so add another complication to it, that every single time you send a prompt to Lovable, it can cost you a different amount of credits depending on the computation intensity of your ask. And then add on top of it that we also have a chat mode or planning mode that also consumes credits in order to plan your project for you before you start actually building. So there's a lot of considerations there and a lot of angst around it. So like people don't like to spend credits on the chat mode, but then if they don't plan what they build and they just start building, sometimes the output is suboptimal. So we did a couple of things here. For example, we wanted to make sure that all of the security issues were always resolved for free. So we eat all of the costs and building costs associated with improving security of your app. We also, if we auto detect that there is a bug, so like the code did not compile for some reason, we fix it completely for free as well. So like it doesn't cost you anything to do it. But AI is still AI. It still hallucinates. It still says that, hey, I've done this even though I didn't do it. And there's still, it's not a perfect situation. So something that like I'm still like losing sleep at night in terms of how do we make customers more happy, given their expectation of AI sometimes exceeds its capabilities in this day. But for credits, I'd say it is a really big problem because you don't know how much it's going to cost you to finish your build or to finish what you actually set out to do. And the interesting thing that we notice is that any team that has ever worked with actual engineers and knows true engineering costs says like, I don't care how many credits this eats. This is like still a fraction of the price of what would it cost otherwise. It's an alternative to hire a full-blown engineering team versus people that have never worked with engineering teams. To them, even like $50 to build an app, they're like, I spent $50 to build this. Are you kidding me? Like, what do you mean? Like, this costs more. So there's like a pretty big spread between people that actually understand the alternative versus not. But we're really targeting non-technical user. So we just want to make it as cheap as possible for them. We actually have our own internal goal of constantly reduce price per credit to make it cheaper and for you to be able to accomplish more with credits. But by design, unfortunately, credit means that it obfuscates what it actually does and what is behind it. And that is the piece that as I said, I'm spending a lot of time thinking about it. Like, can we simplify it into some sort of lovable wallet that you can just like load money in and then spend it, that at least removes this obfuscation layer? Because even credit, you still pay $25 for those 100 credits. So why do we make you do the math if we can just like tie it directly to an action? But don't hold me accountable for it. I'm still ideating on it and seeing how we can potentially spin it around.
Well, I think we have time for a couple more questions. I think there's one on the margin and COGS piece, like for companies still in maybe like early stage startup mode, how do you balance like freemium as a growth lever without taking on unsustainable costs or, subsidizing a user base that perhaps doesn't cover the revenue?
Yeah, so you have to look at the alternatives. If you're not going to spend it in freemium, how are you going to acquire your customers? So, sorry, let me step back. What does freemium do? Freemium removes the friction of entry for somebody to try it out. So if, especially in the new category, in the new space, people need to increase their perceived value to say, hey, I'm actually going to pay this price. The equation of perceived value has to be a lot higher than the price that you pay. And freemium is a really great way to shoot that perceived value high. So then when you see the price, you're like, oh, I get it. Of course, like $25, no big deal. This seems like a complete unlock in terms of what I'm trying to do, or whatever the price that you have. So you have to look at that equation, how you can allow it to happen. A lot of times of pay to play or just like pay trial, you're just not lowering that friction enough in order for people to come through the door. And then you have to look at your alternatives. Like, okay, if you're not going to do freemium, then you're going to have to spend a lot more on your marketing and sales. What is going to be cheaper? Do you want to invest that money into your own users and into the market, or do you want to make Google and Meta a lot more profitable? And that is the decision that you have to make. If you are more effective in advertising and sales, go for it. I'm not saying that's the wrong strategy. I'm just saying that depending on the category, sometimes it makes more sense to invest into your own users and have them be your marketers, because guess what? People that are on freemium usually have highest net promoter score or NPS, and they talk about your product the loudest because they got something for free and the price was and the perceived value is here and the price was 0, and they freaking love it and they're going to tell everybody about it. So if you can start up that word of mouth loop, especially with your freemium, you absolutely should. But I completely appreciate that it's not for every single product and it's not for every single market.
Cool. I think we have time for one more question. So I think you both talked about how we're kind of this mucky middle of figuring out pricing. So question for both of you, like what do you see as the next revenue frontier of pricing AI over the next 12 to 24 months? Crystal ball question.
Scott, I'll let you go first.
Okay, I'll talk about two things that I think are interesting, just observations. So the first is I think we're seeing a lot of like pass-through pricing where basically you take the LLM cost and you like do like a 20% margin on top of it. And that to me feels very early market behavior. I think like fixing margin is like, the way I like to put it is it's like very specific businesses like fixing margin. Like, and they are all infra SaaS businesses that are like want to be monopolies, et cetera, et cetera. And so like, I understand protecting margin. That makes total sense to me, but fixing margin is just like it's kind of code for like, I actually don't think I can provide you more value than like the underlying thing. And I'm just going to be this thin pass through. And so that to me feels very defensive and very like immature market like behavior, which is great. I think it doesn't mean it's wrong. It just means that in the next year or two, that will like go way down in just statistically. And then the second thing that I'm seeing a lot of interesting things is, we've talked a lot about pooled credits. So like there's basically a pool of credits that live at the company level. We're actually seeing interesting behavior where you actually have credits that are assigned to individuals, like a pool, but then the pool is allocated across a team so that basically like different people within a team have like heterogeneous amounts of credits they're allowed to spend. And basically, I actually think that model is very interesting for kind of almost like for larger deployments where you're basically saying, actually, everyone in my org has access to this thing, but the marketing team gets a bigger budget than the engineering team. And so the engineering team can't go steal credits from the common pool. And obviously it's a lot more complicated, but I suspect as these products and they're kind of like refined growth levers come through, I actually think more sophistication in that kind of allocation of credits is something that I'm like paying a lot of attention to, and we're seeing incidental pull from the market on.
Yeah, and I will just say that I completely agree with Scott. We're very immature in the way that we're pricing AI, and that's because the costs are so high. I think that if you look at even OpenAI and how they sell LLM costs to us, they're pricing it under because even OpenAI is not profitable yet from public information that we have about them. So even they're betting on the LLM costs to come down. So the question is how far are they going to come down? Are they going to come down to almost like the normal hosting costs for us that we have, like internet costs, so to speak? And if in that case, do we snap back to some sort of previous pricing models that are going to be per user or let's say per outcome, and who can get there first is going to be the winner in the space, because that's what customers are fundamentally expecting and comfortable with, or do we invent something new? Like, does each product become its own currency? If you have kids that play Roblox, like they have Robux as the currency inside Roblox, and it's like it's its own economy and it's wildly successful. So like, do we go into some like that territory when ecosystems are being created, or do we move towards outcomes more if we can measure them, especially with AI, because we can push it to be more measurable? Or do we snap back to our good old per user pricing that we've had before, because the costs are going to be pretty much trivial at that point, and we can go back to old models? Who knows? I think the time is to tell, but the one thing that I will just say is whoever will be on the frontier in that evolution is going to be the winner in the market within the AI categories. And that's why, for me, it's so important for us to keep a really close tabs to our pricing and packaging and have a very strong muscle internally to be able to change it and impact it, because we know that there's going to be future changes and we want to be ready for it, as opposed to starting to do something that we don't have a muscle trained to do yet.
Awesome. All right. Well, with that, I will say thank you, Elena. This was awesome. Your insights per minute is like probably the highest of anyone I've ever talked to. So
that's my personal North Star metric. So thank you.
I love that. That's like, it's definitely very high up there. Really appreciate it. I hope you have a great rest of your day. And yeah, thank you for everything.
Thank you for having me. Appreciate everybody's questions. Sorry we couldn't get through all of them, but I actually asked for already export of all of them, so I can continue answering them as we go, both on my newsletter, on LinkedIn, and maybe some together with Metronome.
Awesome.
Great. Thanks everyone for joining. We'll send out the recording as well. Thank you.
Bye.
Bye.
Thank you.